Okay, good afternoon, guys. The present time is 12:45, July 9th, 2014, and we are looking here at Apple computer stock. Currently here at 95.51. Again, the time is 12:45, and on the right we're looking at Amazon, currently at 329 and 67 cents. Okay, for those of you that have just come to our site here at Alpha Trading Strategies, we utilize a very distinct approach to the market where we utilize the three pieces of data that is always present in market activity. Those three pieces are price. Currently here at for this price of the stock of Apple is 95.48. Volume, the volume associated with each bar, as well as what we call alpha. The average trader is using lagging indicators. They are basically making directional based plays. They are scalping. They are making numerous trades per day, and they are trading in fear. Our advantage here is that we do not need to use any lagging indicators. If you look at numerous videos over the months and years, you will see that not one is used. The information contained in the chart is staring you right in the face. That's factual. So once you understand what these bars mean, we say it very clearly. If you don't know what these bars mean in terms of the professional mindset, do not trade. Donate the money, because you are going out. If you cannot, in 3 seconds or less, be able to know what this bar means, irrespective of color, you should not trade. I don't care who you are, who you think you are, who you know, where you come from. All of the information is contained right here. Anything else will only confuse you, and this is why, statistically speaking, guys, 85% all retail traders lose their capital in 6 months. So what is the number one thing that we want to do as traders? We want to protect our capital. Our capital is like, literally, the best way I've heard it is it's a tool. Your money is your tool to make more money. Just like a plumber has tools in his or her toolbox. An electrician has tools in their toolbox. They don't lose the tools. Okay, so our tool as traders is our capital. So the number one thing that we have to be mindful of when we're trading is risk. How are we dealing with risk in this particular trade? And how many things can we stack in our advantage so that we minimize risk? That's what we want to be able to do. We want to be able to put as many things on our side as possible. Now, over the years, we have evolved, and the evolution is required. The evolution is part of the human race. We all should evolve. We should all strive to get better. And so we codified, for the first time, we have codified the sequence of a reversal so that we now are able to get into the market at wholesale price levels. Now, let's take a look at yesterday's trade. We entered yesterday right around there. Somewhere right around there. And with Apple, we entered somewhere right around there. Okay? These are wholesale price levels. Okay? These are wholesale price levels. Now, in hindsight, this may look easy. I can assure you that if you don't know what you're doing, it will not, because it will not be easy. Because what other schools of thought are there? Where there's the Elliott wave, that this could have been an AB leg, extending down, or eBay retracement heading even lower. Or let's look at the Fibonacci retracements. This could have been a 0.382 retracement, which means that in Fibonacci lore that it's a typical retracement, which means that the move is still in effect. And so people would short this retracement here, looking to establish price even lower. No, 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 no. Everything right here, guys, is right here in front of you. Price, volume, alpha. Price at a certain price, professional money is going to want in. They've manipulated the move so much so that it's now desirable to warrant their participation, both in a falling market and in a rising market. So that was our entry yesterday, but did we buy the futures? No. Did we sell the futures? Well, obviously not, because this would have been a directional bias up. But we did not buy the stock. What did we do? We turned around and we moved into an arena that gives us more advantages. What are the advantages that we can be given? First of all, we can be given time as an ally to us. So what we want to do is we want to be sellers of the put options that are being marked up heavily on this massive downwards move. We want to be sellers of the put options on this massively downward move, because they are attaching, there are three components to an option. One is its time value. Now we are looking at selling weekly options, which means that from Friday or Thursday until Friday, that is the lifespan of the option. Now Monday and Tuesday of the week, the time value is a linear progression, meaning that the time value does not really begin to decay or accelerate until the last couple of hours of Tuesday. The other component is real value or intrinsic value. Where is price in relationship to the spot price or the strike price of the option? And then that third beautiful thing that eludes the public is what's known as volatility premium. Now, volatility is the movement of price over time. It can accelerate at different rates over time. Time is standardized, but price movement up or down through that time space is not. And that's where they get to lump on the cream. So when they are bringing the price of the option, when the price of the stock is going down, the put options are getting marked up heavily because people are wanting to buy those puts, and the writers are happy to sell it to them. So we want to go in with a defined risk, which we don't know in futures. We want to be able to know what our probability is, which we don't know in futures. We want time on our side, as we don't have in futures. And we want a excessive amount of premium being placed in which we can sell it to the public, as well as we want a non-directional path to make money. So after we sell the option, to a certain degree, price can go up, it can go down, it can go sideways, but it's got 7 days. The buyer of that option's got 7 days to perform. Warren Buffett, one of the greatest individuals, Warren Buffett was quoted as saying that Berkshire Hathaway is one of the worst investments he'd ever made. Of course, he's famous for it, but in hindsight, he said he should have bought more insurance companies. Warren Buffett is a very big seller of put options because it allows us to collect that premium up front, the same way that insurance companies collect a premium. They have a probability of you not having an accident, or the likelihood of an accident, in relationship to the premiums that you pay, and they know that one is bigger than the other, and insurance companies have been around for a very big period of time. Same thing here. We're collecting that premium up front, and this is why female traders are falling in love with, we're teaching more female traders than ever before, because they get this. They get being the bank. They get not having a gun to their head. They get a non-directional pathway to making money, as opposed to in futures, you can only make money if it goes up. That's it. So let's take a look at what happened and what's going on today. Okay, we sold the Apple option yesterday. We collected 500 in premium into our account. That money, if we closed it out right now in less than 1 day, we've already got 400 of the 500. Okay. Amazon, we've got about 7,900. We wrote about $7,900 in premium. Of that so far, in less than 1 day, we've already captured, meaning if we close this out right now, we would capture 4,000 of that. Okay? Now, to put that option on to collect the possible 500 required 1,800. So up front, you know that you've got a third. Let's look at the numbers here. You have a potential 35% return on the option that you write, and you could have written 50, you could have written 5, you could have written 1, you could have written 500, but you know exactly what is going on up front. 35%, and we've captured 400 of that, which is we've done over 25% on this in less than 1 day. You can do that in the options. Now let's take a look at those strike prices. 93, we sold the 93.57 put. That's the one that we got the biggest premium on. Let's take a look at the possibility of that, of price touching that. Okay, here we are. We sold the 93.57 put, probability in the money. This has only a 10.18% probability of this price touching us, or price going down to 93.57 in 2 days. We have almost a 90% probability that this will expire worthless. I like those numbers. Let's look at Amazon. We're up about 4,000 on that. We sold the 317.5 put, and so let's take a look at the one that we sold. We'll always receive more in the one that we sold. Let's look at the probability of that coming in the money. Okay, the 317.5 put that we sold has a 7.3% in 2 days, is when this expires, 7.37% probability of being in the money. 92% probability that this will expire worthless. And so these right now are just dying a slow death. And as you see, it's just inching up higher and higher. So that's going to do it for today, guys. We're heading off to Catalina. It's going to be a great day because there's nothing to do. Wednesdays, typically, there's nothing to do. Thursdays, typically nothing to do because these are bleeding out. And this is why now we have combined the power of that alpha trading matrix, the alpha matrix. And we ask you, when we teach you, we teach you those bar types. But instead of trading in a directional environment only with stops, futures, and that sort of stocks, we now combine that. We put all of these things on our side. That's going to do it for today, guys. We're off to the boat. Take care.